Today is Sunday, tomorrow is Monday. That means it is time to talk about what is going to happen with SoFi stock this week, as well as talk about the broad markets, because as you guys do know, SoFi has not had the greatest run as of recently. This could get much better or it could get much worse coming this week. Why is that? Well, because the Fed has their meeting on Wednesday. This is something we have talked about extensively here over the course of the last couple of weeks, but it is now upon us, and we must talk about what is going to happen after the Fed. Are we going to drop in a massive way? Are we going to rip in a massive way like we seen during the last Fed meeting? So we got a lot to talk about. We got a lot to get into here in this video. Hit the like button, subscribe to the channel if you guys have not already. Thank you for those of you that went ahead and did that. Sometimes you need a little quick reminder, and that's what that is for. So let's dive straight into exactly what is going to be happening this week. And let's start with the economic data that is coming out. So on Monday, let's see where I am on here. On Monday, you do have ISM manufacturing PMI. And that's going to be very important. Why is that important? Well, that's a key source of inflation that the Fed does look at. Their Fed meeting actually starts on Tuesday. It ends on Wednesday at 2 p.m. You get the Fed report, and then you get the Fed conference with Jerome Powell at 2:30. So that's going to be very, very important. You're going to see a very violent market reaction based off of what happens, with that Fed report. It's going to either rip in a massive way or it's going to drop in a massive way. Now, on Tuesday, you have another big catalyst as well, which is the JOLTS job openings. Now, why is that so important? Well, the job openings, or I should just say negative economic data, can be seen as a positive thing. Why is that? Well, it could potentially slow the markets down in this sell-off. It could slow the Fed from raising rates as aggressively as they planned. And just for an example here, the US GDP fell at 1.4% pace to start the year as pandemic recovery takes a hit, and that was April 28th. What happened here on the S&P 500? April 28th. Well, the S&P 500 was up 2.53% to close the day, even after that terrible economic data, literally saying the next quarter, if that growth is also declining, that we are in a technical recession. But the markets did not care. They rallied 2.5%. It really took the federal funds rate, the projected federal funds rate, down in a very substantial way. Then what happened on Friday? The next day, the SPY closed down 3.7%. The NASDAQ closed down 4.17%. Russell 2000 closed down 3%. It was a very bloody next day. And we have a lot of economic factors that are going on. Yes, China is locking down. War in Russia and Ukraine, that is all playing a role into what is happening with the markets. But by and large, you've seen tech stocks not hold up based off of earnings. Amazon got killed. Tesla did not get killed because of earnings. They got killed because of the Elon and Twitter deal. They got destroyed, right? Google did not do so well either. Microsoft did decent. Apple, they did good, but they also guided for much lower revenue in Q2. So by and large, the large cap tech stocks did not report good enough earnings to hold the markets up in a substantial way. So that's really what happened on Friday. Now, what's going to happen on Wednesday? Like I said, that Fed report comes out at 2 p.m. And then you have the press briefing at 2:30 p.m. You're going to see that very violent market reaction. You're either going to bounce after that, like we seen during the last Fed meeting, and that was March 14th. Markets instantly rallied, and it was pretty much vertical in the S&P 500. This was literally a historical rally. This is more vertical than the crash of 2020 recovery. Like, the stock market went straight up after the Fed meeting. Now, the Fed is expected to raise rates by about 0.5%, but last time Fed Daliad came out and said that they should raise rates by 0.5%, the markets absolutely sold off because of that. That was one of these big days right here. I can't remember the exact day. I believe it was this day where the S&P did close down 2.74% right here on April 22nd. That was because Fed Daliad came out and said, hey, we should raise rates by 0.5%. The markets were pricing it in on paper, but they really had not expected the Fed to go that extra step and give us a double rate hike. So I don't know how much of it, and I can't be confident how much of it is actually priced into the markets currently. If it's not priced into the markets, you're going to see a very negative market reaction. Or if the Fed comes out and surprises us, it's very likely that you could see a very negative market reaction, because after all, think about stocks like PayPal, like Square, like SoFi, like all of your small and mid cap stocks in general. They're all down under their 2020 highs, right? The 2020 high was right here. A lot of these stocks are way down here. If you go ahead and pull up something like PayPal and look at its 2020 high, you're substantially under that. So the only thing that has really held up the markets, look, this is the 2020 high. I mean, that was like 130. The pandemic crash low was 82.07. PayPal went under 82.07. I mean, it went right here, 82.12, and then finally did hit a little bit of a bottom. So to think the markets could not come down in a substantial way, I think would be very naive and really doing everybody a big injustice by saying that. Now, is that exactly what I expect? Not necessarily. Now, the S&P on Friday did close at its worst price point in 2022. Now you'll say right here, like, look, we went down lower than that. Yes, the S&P hit 409.37 right here, and this was on February 24th. We actually opened at 409.75. The high was 427, and then we did close at 426.97. So we've seen a very historic rally on this day. We reversed like 5% of market value in one day, being down dramatically and then closing up on the S&P about 1.5%. Now, if the Fed meeting comes out and it is very bearish, it's taken by market participants as very bearish, you're at a key level. You're at pretty much that 110 price. You're very close to that. You're at about 413.43 right now. If we do close under 410 or even close to 400, you are in no man's land. You've seen a gap right here from about 392 all the way up to about 413. If we do break under the 413 level, which we're at right now, it's very possible you could head back down to 395 on the S&P to close that gap and really find a bottom down here. Or it's possible you go as low as 360 on the S&P, finally find a low, and then we can make a bottom off of that. Because at this point, when you get a market crash and you actually get a bottom that people start to buy, the first stocks that go are the stocks that have already went. The small and mid cap stocks, they get destroyed. They have already been destroyed. Very, very clear here. If you're invested in any of those kind of companies, you've gotten absolutely destroyed. The last thing that actually goes are your large tech stocks. Earnings did not hold them up, so they are on the chopping block and they can fall with the overall markets, especially the stocks like Amazon that performed very bad off of earnings, really could be the ones to help tank the market in a very dramatic way. Now, it is very possible. I don't want to say, it's only a one-way street here that we're just heading straight down into the ground, but it is possible that we do reverse. Like we seen March 14th, the Fed actually came out, raised rates 0.25%, like what the markets were expecting, and the market's seen that historical bounce. So it could go either way here, but I think the fact that we did close at the lowest point of 2022, and actually the NASDAQ as well as the Russell 2000 hit a new 52-week low on Friday, I think it goes to show that we're kind of in no man's land here, that the odds of us seeing a bounce after the Fed are a little bit less likely than actually seeing a drop after the Fed. But obviously, I'll keep you guys up to date if anything changes with the war in Ukraine, or if the lockdown in China situation changes. This could be a totally different video, but as of right now, it does not look all too good. Now, as far as SoFi stocks, SoFi did not do all too bad as of Friday. It was down 5.12%. It was up 0.16% here in after hours. We did not hit a new all-time low. The all-time low was actually set on Thursday when SoFi hit $6.02 per share. We closed at $6.12 per share. So it could have been worse. Yes, it was still bad. Overall, I think it was good that we did not hit a new all-time low. It's pretty much every time I make a video on SoFi, we start off the video by saying SoFi stock hit a new all-time low. But SoFi did not. on Friday. So I think that is very, very good. If for whatever the reason, shall be, the markets do come down in a substantial way, it will likely be based off the Fed. I would watch that $5 level to really get a lot of support, and then that 50-day moving average at $8.90 per share, that's going to be your main level of resistance. If we break out above that, then $10, $11, $12 per share is very, very possible. Now, I will say, before we go ahead and wrap up this video, I do want to look at the Ortex data here in just a second, but I want to make the point here that think about a stock, think about sentiment, think about what is going on with the business and where it's currently at. What I mean by that is SoFi stock has had its largest segment of its business, the largest segment accounting for total revenue, which is student loan refinancing, has been completely shut down over the past 2 years, right? Sentiment for interest rates increasing, the Fed putting us into a recession and killing all demand is at its all-time high. So right now, really, the way I see it with SoFi is that we are either right in a big way or we are potentially wrong in a big way. If demand gets killed, credit markets shut down, we go into a 5 or 10 year long bear market, then SoFi stock is not going to perform very well because earnings and revenue will ultimately be hit. And then the story for SoFi is going to take a lot longer, right? I won't say it's dissolved even if that happens, but it would take a lot longer. Now, I personally don't think that will happen. I think, yes, the stock market is going down. The Fed is raising rates. Yes, it is hurting demand. But at the same time, I don't think there is systemic problems like we seen during 08 and that crash. Comparatively to what we see now, I think it all comes down to a big economic boom and then an economic contraction. And I think SoFi stock will emerge from this very prosperous, and anyone that is buying the stock at these rock bottom prices, like the sentiment could not get worse. The overall market conditions could not get worse unless there was, a systemic problem that we don't know about. But I think it's pretty clear we would know at this point about some level of systemic problem, either in the banking segment or financial markets in general. We would know something. And the fact that we do not sit here, and say there's a reason for SoFi to go down 5, 10 years, I think it offers a very high level of risk to reward. Basically what I'm trying to say with that. So either we're going to get paid out big or it's going to take a while for SoFi stock to pay out. But I am personally confident in my bet. I'm still down about 55% here on my position. My average cost is probably a lot higher than some of you guys. It's at about $13 per share. But nonetheless, we're in there like swimwear, baby. We are not leaving. SoFi stock is here for the future. It's fintech. People are not gonna choose the bank over a fintech for their finance solutions over the next 5 to 10 years. So I feel confident in SoFi, very, very confident in that way. Now let's look at the Ortex data and then let's go ahead and wrap up this video. So the short interest of free float is sitting at 20.07%. Current shares that are sold short of 145.01 million. Cost of bar max is sitting at 3.7%. Utilization is at 100% and days to cover is sitting at 3.87. Now the option activity, I do want to point out that a lot of the near-term option activity like the May, June, July expirations are very, very bearish, but you do have a lot of long-term call buyers stepping in and buying the 2023 and the 2024 options in between the $5 and $10 strikes, and they are loading up on those in very substantial amounts. Look at that options trade, $535,000 for the $10 2024 SoFi call. So, a lot of negativity here in the short term, but a lot of bullish activity for the longer term. Now, the option activity for Friday was 5 orders totaling 3.13 million, positive order value of 95%. Over the past week, 61 orders totaling 14.02 million, positive order value of 85%. So things are looking pretty damn good here in that regard as far as long-term bullish option activity from hedge funds and institutions. And ultimately, once people have to pay back their student loans, that's when SoFi stock will ultimately go through a major rally as that huge revenue stream does come back to the business. So that is going to be all for this video. Hit the like button, subscribe to the channel, source your comments, questions, or concerns down below in the comment section. Thank you guys for tuning in. Enjoy the rest of your day, and I will see you in the next one.